So let's explain in details the call option contract. The call option contract is a contract between two parts. There is one here, someone here, and there is another one also here. So the first one here, that in the left side, I'm going to call it the buyer, who is going to purchase the option contract. And he's going to purchase it from someone else on the other side, and this is one is the seller, and he is also the writer. So he is going to write this contract for the buyer. This contract will include some information. The first one, what is the company name, the stock name that we are going to trade on. The second information is related to the volume of the stock that we are going to purchase, how many shares we are going to put in this option contract. The number three is related to the strike price, okay. And number four is the duration of this contract. What is the duration? Is it 30 days, 40 days? So we need to agree on the duration, and this is a standard terms, by the way. The last information on this contract, that there is a cost to purchase this contract. This cost, the buyer must pay it to the seller. So we are going to call this cost as initial investment, or the cost to acquire this contract in the beginning. And this is always is paid on day number one, and also this is very minimal investment. So this is a very minimal cost. Let's take an example in order to explain this contract in detail. So the example here that we are going to present, we are going to consider the first information is the company name. So let's say that this buyer is in a love for a company stock called ABC. So we are going to say we have company ABC. And the second information here is related to the volume. Let's assume that it is related to how many quantity. It will be 1,000 shares in this company. Okay. The third information is related to strike price, and we are going to assume that the strike price here is $55. This is the strike price. And the fourth information is related to the duration. So I'm assuming that it is 30 days from the date of the purchase of this contract. So this is the duration. So it is 1 month from purchasing this contract. And the last information is related to the cost and investment that this buyer is going to pay to the seller to purchase this contract. So let's assume that this cost is $1,000 for the whole contract. And as long as the whole contract is related to 1,000 shares, so the cost per one share is $1,000 divided by 1,000 shares. So the cost will be $1 per share. So this is the details of this contract. Now let's calculate something called break-even price before we start explaining the scenarios that we have. So the break-even price, this is something that we need to determine, and always related to the buyer. Now, how much is the strike price here in this case? The strike price here is $55. And if the buyer is going to exercise this option, he should pay $55. How much is the cost to acquire this contract? The cost is $1,000 for the whole contract, and as long as the whole contract is 1,000 shares, so the cost per share is $1 per share. So let's write this information here. The strike price is is $55. So this is the strike price. And also we have cost. So we have cost to acquire this contract, or the investment to purchase this contract, which is $1,000, and per share it is $1. If you would like to calculate the break-even price, so you have to sum up these two components. So 55 plus 1 equal $56. This is the break-even price, and this is the point that the buyer of the contract will start to realize gain. Okay, we are going to take scenarios to explain all of this. We need also to understand that the cost to purchase this contract, which is $1,000, is a sunk cost. Sunk cost. And this is in managerial accounting something that you paid in the past. So 1 month ago, we paid this $1,000 in order to acquire this contract. And as long as you already paid in the past, so it will not impact your decisions in the future. It will not be relevant for your decisions in the future. So it is a sunk cost. So what I would like to say that this sunk cost is irrelevant for any decision you are going to take. And what is the decision that the buyer is going to take? Mainly the buyer is going to take a decision whether to purchase this stock from the market or to purchase this stock through exercising this contract that I purchased before. So when you are going to take this decision, you don't need or you shouldn't consider the price or the cost that you paid before, which is the $1,000. So this is a sunk cost that you already paid. Let's take examples in order to see what are the scenarios that we have. Assume that the market price for this stock, this is the first scenario. The market price for this stock is, for example, $40. Okay, now the buyer should take a decision. Should the buyer purchase from the market? Purchase from the market or exercising and using the option contract? Let's say, if the buyer is going to exercise and use the option contract, he must pay the strike price, which is $55. But if he would like to purchase from the market this stock, he is going to pay $40. So if you are in the position of the buyer and you have two options, one of the options is to purchase from the market and they pay only $40, and the other option is to exercise the option contract and they pay $55. So now the decision here is very simple. You need to consider the lowest cost on your side in order to get this stock. Simply, you are going to purchase from the market and pay only $40. So this is the decision that you are going to take. So purchasing from the market. Now, what is the loss or gain for each party, for the buyer and for the seller, which we called before the writer? Now, we need to calculate the cost and gain, the loss and gain. And this loss and gain, we are going to call it payoff schedule. So we are going to prepare this payoff schedule. Let's start with the buyer. The buyer is going to purchase from the market and is going to pay 40. Is the buyer lost anything, or did the buyer lose anything here in this transaction? Yes. The buyer paid already 1 month ago the cost to acquire this transaction, which is $1,000. This is the cost to acquire. Okay, so this is the cost to acquire the option contract, and the buyer didn't use the option and he's going to purchase from the market, so he paid something, will not get a benefit from it, which is $1,000. So this will be loss for the buyer. And this is the maximum loss that the buyer is going to charge anytime, or as per any decision and as per any scenarios in the market for any price. So this is the maximum loss. How about the seller? The seller, he will keep the option contract. The buyer will not ask him in this scenario to exercise. So he already collected $1,000 to sell this contract, okay, to the buyer. And as long as the buyer didn't exercise the option, so this one will be considered as gain. Let's understand something here. The loss for the buyer will be exactly the gain for the seller. So will be the same amount. The loss in one party will be the gain for the other party. So the loss will be the gain on the seller or on the writer side. Okay, now we are going to call this scenario for the buyer out of money. So the buyer is in a situation out of money. Why out of money? Because he didn't exercise the option. He purchased the option. He didn't get a benefit from it. He didn't exercise because actually the market price is less than the exercise price. So now in this case we are calling the buyer as out of the money. And on the other side, the seller, we are going to call him in money. In money. Or in the money. Okay? In the money. This means that the seller achieved gain, so he is in the money. The contract is in the money for the seller. So these are the main concepts in this transaction. Let's take another scenario in order to explain well the issue. Assume that in scenario number B, the market price is $60. Again, we need to take a decision. If you are a buyer, you have two options. Either to go to the market and pay $60 to acquire or to purchase this share, or to exercise the option, and in this time you are going to pay the strike price. You are going to pay the strike price, which is $55. Which is more beneficial for you, paying $60 or paying $55? Definitely the answer is to pay $55 and acquire the share. So the buyer is going to take this decision. He is going to exercise the contract and pay $55 to acquire this stock. In this case, the buyer is going to purchase from the market. Is to exercise the option and pay $55 to get this share, and then if he would like to sell in the market in the same day, he is going to sell on 60. So the buyer here will achieve gain equal to the difference between 60 and 55. So the gain here will be $5. This is the difference between the market price and the exercise price. But careful, because actually the buyer paid before $1,000 to acquire this contract. So if you divided the $1,000 by the 1,000 shares, so the result will be $1 cost per share. So actually the cost that the buyer paid before is $1. This is the cost to acquire this option. So this is cost he paid, and this is gain he is going to realize. So the net gain in this case will be $4. This is the net gain for the buyer. If you multiply by 1,000, so the total gain for the buyer will be $4,000. Will be total $4,000 for the buyer. How much investment did the buyer paid in the beginning? The investment he paid in the beginning to acquire this contract is $1,000. So imagine that the buyer paid in the beginning $1,000 as investment and achieve gain $4,000. So now the gain percentage or the income percentage will be 4,000 divided by 1,000, the investment that he paid. So the result will be 400% return. So it will be 400% return on his income, or in his investment, I mean. Okay, let's go for the other side, which is the seller, and we call it before the writer. Now the seller, he will be in a situation that the buyer will exercise the contract. So the seller is obliged to purchase this stock from the market in order to give it to the buyer on $55. So the seller is going to purchase the stock from the market on 60, and he's going to pay 60 and collect from the buyer 55, which is the exercise price. So the net loss here will be $5 as net loss for the seller. But careful again, the seller collected in the beginning investment to sell this contract to the buyer, which is $1,000. And per share, it is $1. So the seller here will consider that I collected before $1. So the net loss for my side, or on my side, is $4. Will be $4. This is the net loss on the seller side. On how many shares? The seller is going to multiply by 1,000 shares. So the total loss will be $4,000. This is on the writer side of the call option. So this will be total loss $4,000. Okay, clear. So the total loss will be $4,000 on the seller side. This is the total loss. So the total loss on the seller side is $4,000. Now in this case, the buyer, because he achieved gain, so this gain will put the buyer in a position of in the money for the contract. So in the money. So the contract will be in the money for the buyer. And for the seller, this will be out of the money. Because actually the seller is in a position of loss. And if you again note that the total gain for one side equal to the total loss from the other side. This is very simple explanation for the option call option contract. Let's take an example in more details on Excel file to see the whole scenarios that we have.